All right, welcome back to Talk Tickers. Today we're digging into Green Plains. That's ticker GPRE. Now, their latest earnings call was a big one. Management is basically telling the world that this is a huge turning point for the business. But the question is this real, sustainable progress, or is it all just some fancy accounting? Let's dive in.
So get this, the headline here is a massive, and I mean massive, 250% earnings surprise. The stock shot up just like you'd expect, but then it fizzled out pretty quick. And that brings us to the big question we're tackling today. Why in the world, after a beat that huge, is Wall Street still so skeptical? Why aren't they buying the story?
Okay, so here's how we're going to break it all down. First, we'll look at the Q3 report card, the raw numbers. Then we're going to peel back the onion and look behind those headlines. From there, we'll get into management's new pitch, check out Wall Street's reaction, and then we'll wrap it up with our own prediction for the next call. All right, Section 1, the Q3 report card. And really, it's a tale of two cities, a story of big beats and some pretty significant misses. And this table pretty much tells you everything you need to know. Look at earnings per share, or EPS. They absolutely crushed it. Wall Street was expecting a loss, and they delivered a solid profit. But, and this is a big but, look at revenue. A huge miss by almost 13%. And adjusted EBITDA, basically flat year over year. You know, it's the classic confusing beat and miss quarter.
I mean, just look at this chart. It really puts that earnings beat into perspective. The market was totally prepared for them to lose 3 cents a share. Instead, boom, they post a 17-cent profit. That's where that incredible 250% surprise number comes from. It's a huge swing.
But then you flip the coin over and you see this. That amazing earnings beat happened while revenue fell way short. They were supposed to bring in close to $590 million, but they only managed about $508 million. So you see the problem, right? This is the core conflict that has investors scratching their heads.
So how do we make sense of this? Well, we've got to go behind the headline numbers. It's time to peel back the layers of the GAAP onion, because the official numbers were packed with stuff that hides what's really going on. So what we're looking at here is the difference between the accounting illusion and the actual business reality. The official GAAP earnings were just loaded with volatile one-off items, things like plant sales and debt costs, that really don't tell you how the core business is performing day to day. We need to strip those out.
Okay, case in point. They booked a $36 million gain. Sounds great, right? But it was from selling off their plant in Tennessee. That's a one-time cash injection. It's not going to happen again next quarter, so it artificially inflated that profit number.
And then, on the flip side, they had a huge cost of almost $36 million. This was a charge for paying off some of their expensive debt. So you have this huge gain and this huge cost, and they pretty much cancel each other out. But man, does it make the income statement messy and hard to read.
Now, this slide right here, this is probably the single most important thing for Green Plains' future. It's all about these new 45Z tax credits. So what are they? Basically, it's a new government incentive that rewards companies for making their fuel cleaner by lowering its carbon intensity, not just for cranking out more volume. This is a complete game changer, and it's at the absolute heart of their new strategy. So once you strip out all that accounting noise we talked about, what's left? Well, the real operational story is actually incredible. They ran their plants at over 101% capacity. That's a 10-year high. They were hitting record or near-record yields on everything: ethanol, corn oil, protein. And on top of that, they recognized $25 million in value from those new 45Z tax credits. So from a pure operations standpoint, this was an absolutely fantastic quarter.
Okay, so this brings us to management's new pitch to investors. They're taking that strong operational performance and saying, folks, the inflection point is here. This is the new Green Plains.
And you can hear it right from the new CEO, Chris Osowski. He called it a milestone quarter. Now listen to the words he's using: operational excellence, discipline, execution. That's not just corporate buzz speak. It's a signal to the market that the days of messy restructuring are over, and the focus now is all about delivering consistent, clean results.
And a massive piece of this new pitch is what they've done with their balance sheet. They've basically hit the reset button and de-risked the entire company. I mean, look at the steps. They sold that plant, they took the cash, and immediately paid down about $130 million of really high-cost debt. Then they refinanced the rest of their debt way out to 2030. The bottom line here is huge. For the first time in a long time, debt is not a major worry for this company.
And this number just says it all. Since the end of last year, they have cut their total debt by over $220 million. That's not just chipping away at it. That is a fundamental transformation of the company's financial health. It's a really big deal.
So you've got stellar operations, a fixed balance sheet. Seems like a slam dunk, right? Well, let's see what Wall Street had to say about it. Was this the real deal or just a one-day wonder?
Well, the stock chart tells a very interesting story. On earnings day, the stock just took off. I mean, it jumped over 12% on huge volume. We're talking 3 times the normal amount. Pure euphoria. But then, look what happened. In the weeks after, all that excitement just vanished. The stock trickled back down and gave up almost all of those gains.
And it's not just the stock price. The professional analysts are cautious too. Even after that huge earnings beat, the consensus rating is a hold. 50% of them are on the sidelines. What that tells you is they're in wait-and-see mode. They're saying, great quarter, guys, now do it again. They aren't fully sold on the turnaround just yet.
All right, time to put all the pieces together and look ahead. This is the next call, our take on what's going to happen next with Green Plains.
So here's our prediction. For the Q4 results, we're actually calling for another beat. The key driver is going to be another $15 to $25 million from those 45Z tax credits. But for the stock price, we think it's going to stay range-bound. Why? Because the market needs proof. It needs to see consistent execution, not just one great quarter. So our official rating is market perform. The story here is absolutely compelling, but the execution risk is still there. They have to prove it.
So if you want to put this thesis to work, what's the move? Well, here's our outrageous but plausible idea. A pair trade. You go long Green Plains, betting on their very specific transformation story. But at the same time, you go short one of their peers that's still just a plain old commodity ethanol producer. The idea here is to isolate what makes Green Plains unique. You capture the upside from their low-carbon strategy while hedging away the general risks of the up-and-down ethanol market. It's a pure play on their transformation.
And as always, just a reminder that none of this is financial advice.